Hi, I'm James Robinson, and this is my stock pick of the week. This is part 2 on my series on the company Sturm, symbol RGR. And generally speaking, operations for me is a look at the efficiency with which a company delivers goods and services to their clients. And Ruger's an interesting case because it's probably the least efficient company that I've recommended. And I'm recommending it in large part due to three factors. First of all, the financials are great, and the wealth management is great, and they make up for the operations. Also, I believe that this industry is in a bit of flux, and I think that there's some real upside in this industry. We're buying the stock very, very cheap at 13 times earnings. The stock is paying currently a 4% dividend. So when you add all that up, I'm willing to overlook some of the operational things. Having said that, I don't look at Ruger as being a very, very long-term hold for me. I think we're gonna buy it, we're gonna hold it for some period of time, hopefully make a nice profit, and then maybe keep our profits invested in the company and take our original investment back out and go find something else to do with it. So without further ado, these are the operations for Ruger. I always start the operations by looking at the company's gross margins. Gross margins, for those of you who don't remember, is the difference between the total revenues and the cost of goods sold. So it's really looking at what does it cost to make our products. And it's also a measure of to what extent is our product a commodity. If the gross margins are very, very low, we're likely selling a commodity business, the commodity product, which is really pretty similar to other products of the same type. Airlines being a great example. You don't really care whether you fly Delta or United or whatever the airline is in your country. What you care about is the price, because the seats are all the same and they are going to get you to the same place in the same rough amount of time. So there's no differentiation. You simply buy the cheapest product. And it's hard to make a lot of money on commodity businesses. And Ruger probably is a semi-commodity business. And I would be breaking one of my rules, or one of Warren Buffett's rules about buying companies with wide moats and monopolies. And this is much more of a Ben Graham type investment. We're simply buying a company up significantly below what I think it's worth, and we'll hold it until the company is worth what I think it's worth, and then I will sell it for hopefully a profit. So looking at the gross margin of this company, the red line on this chart is the minimum gross margins at which I would invest. And this company is approaching that, but it's not below it. And there's a reason I've set this gross minimum as the minimum. And if you're above that, I will still consider it. Again, if you look, you'll see the margins have been getting lower since 2017. They're even lower than really they have been since 2009. So why am I wanting to buy this company right now? Well, I know that the market for firearms is very, very tight. I know that it's hard to buy guns right now. We do some recreational shooting in my family, targets, really no hunting. And so we have several guns, and my son has recently been on the market to buy a gun and finding it impossible to buy one. That is anecdotally matching up with what my research is showing, which is that due to the pandemic, due to the riots, due to a number of cases, people feel less safe, and so they want to have a gun in their house. I also know that the inventories for Ruger are way down, which means that they're not able to produce guns as fast as they would like. And so I believe that we're going to see these numbers, both in terms of gross revenues and in terms of margins, increase because the company has some real pricing power now that they don't normally have. I don't think that's a long-term trend. I think it's a short-term trend, but it only has to happen for 2 or 3 quarters for the stock to spike and for us to make some money on this company. So you look at these slides, the next thing that I care about after gross margins are the earnings, and what do the earnings look like? Warren Buffett has a favorite saying, which is you pay a hefty premium for a cheery consensus, which basically means if the stock does well all the time, everybody's gonna want on the stock, and the stock is gonna be very highly priced. So you have to be willing to look at some companies that don't have these fantastic up and to the right charts all the time. What I like about this company and what I see in this chart is that the earnings can spike significantly in a good year. So you have a bad year and then the earnings in a good year can jump up immediately. So I like that because I believe that the company has had some years that have been great, but I think good years are coming, and I am expecting a giant stock spike. When that stock spike happens, I'm expecting investors to pile on, and when they pile on, I'm expecting us to make some nice profits. And so while this chart normally would be a negative, especially a negative if I was a very long-term holder of a company, as a Graham investment, I'm not upset with this at all. I recognize that, yes, the thing peaked at 2013, had another peak in 2017, and it's been going down in terms of earnings and earnings per diluted share since then. Again, the company has no debt. It hasn't lost any money, and we're buying it at 13 times earnings. So even at these numbers, I think we're buying it cheap, and I expect really good spike in earnings. Net earnings as a percentage of revenue, I think, is an important measure for us because it basically says, for every dollar we make, how much of that flows down to the bottom line as profits to us, the shareholders. And generally, I like to see a company in the top 25% in this category. This company's bounced around the top 25%. Last year, it was below it. I'm highly confident this year that it will be above it. So again, we're really just trying to track this company and see what's going on. The other thing is, even in the bad years, this company's been able to do $400 or $500 million worth of revenue, and I see no reason why that can't, why that won't continue. And so, again, I recognize that. Let me start over. You have to remember that as I started this, I said the operations of this company are not exceptional. They are merely adequate, and maybe even slightly less than adequate. I'm buying this because I'm buying it cheap. I like the other components I'm going to talk about in other videos. And I think that there's improvement here coming due to the market. So we could spend a lot of time dissecting these things, but if you look at these things in a vacuum, they'll dissuade you from buying the stock. And maybe they should, maybe you don't want to buy this one. But I think we're going to do fine because of the macro picture, not the micro picture of each of these individual charts. We talk about, I always talk about the 5 taxes that a company has. So we have, basically the company has their gross revenue, that's the total money that comes in the door. Then they have costs of goods sold. That's what it costs to manufacture the product. What's the difference between those two is the gross margin. And then we have what I call the operational taxes. And that's things that a company has to do to run its business, which it can do more or less efficiently and can be done more or less efficiently depending on the industry a company is in. So I look at those as taxes, and not every company is taxed the same. And I generally look for companies that do better and better jobs in some or all of these categories. So the categories are selling and general administrative, plants and equipment, research and development, inventories, and interest payments. So selling and general administrative for this company is kind of not an exciting part. It's going the wrong direction. I look at selling and general administrative relative to gross profits, and it's been going up. Now, that'll often happen in a commodity business. You have to work hard to sell your products. And when you have a commodity business and your income has been going down, you still have to work just as hard to sell your profits. And so you'll see these numbers rising, which is what's happened with Ruger. My prediction is that in 2021, that you will see a decrease, and maybe a significant decrease in that category. The bright spot, and a very significant bright spot for this company, is plants and equipment. So Ruger has about 2.5 million square feet of owned real estate, and they have $2 million of debt. So effectively, they own all this real estate outright. I happen to know the real estate is mostly industrial property, and I believe that the value of industrial property really across the country has been increasing. I work in commercial real estate in my day job, so I feel like I understand this. To say that real estate's worth $100 a foot on aggregate is probably reasonable. I haven't done the research to confirm that. I don't really care because I'm not buying this as an asset play, but I think plants and equipment, this company has got significant asset tied up in its plants and equipment, but the value of those assets is increasing and not showing up on the books, on the balance sheet, because you keep real estate not at its market value, but at its purchase price on the balance sheet, and in fact, you even depreciate some of those assets out over time. So when you look at this and say plants and equipment as a percentage of assets has been going down every year, this is a good thing, and I'm actually excited about it. Again, I don't really think liquidation of this company is going to happen anytime soon, and we're never going to capture that value, but it's still there. These two charts are actually not bad. The first one, it looks at inventory as a percentage of revenues. Now, we've talked about the revenues have been down. So even though revenues have been down, oftentimes when revenues decrease, it means you're not selling what you used to sell, but you still got all this capacity to manufacture, and the result is that your inventories will increase because you're not selling the amount of stuff you're producing. But with this company, even though revenues have gone down, they've still managed to reduce inventory. So remember, I don't like companies with lots of inventories. I like companies who have as little inventory as possible. And so this chart, when you look at it, you see inventories going down is actually a positive. Inventories is in related to revenues. It's actually a profit. It means the company is doing a better and better job of managing their inventories. And we like that for a number of reasons, not least of which is you tie up a lot of cash when you have a lot of inventory. R&D for the company, they don't show that they spend a lot of money on R&D. I happen to have looked at the annual report, and I believe I saw that you have either 55 or 75 people working in various components of R&D for the company. And I don't know why I see that oftentimes that companies are bragging in their annual reports that they spend lots of money in R&D, and yet in their annual reports they're not showing R&D. I believe that it's because there's some minimum amount of expectation for R&D in order for you to be able to quantify it and qualify it as R&D. I don't understand the accounting rules enough to know what that is, but I do know that they are spending money every year trying to develop new guns and improve the technology of the guns they have. And I do know that I've double checked this, they do have no cost for R&D in their income statement. Interest payments are a big tax on profits for a company, and this company has $2 million of debt on a $500 million, $600 million kind of sales to $1.1 billion net worth company or market cap company. So effectively it has no debt. And this is just demonstrating this in this chart that while they are paying, a fraction of 1% of their operating income in interest expense, it's an irrelevant number, one we wouldn't worry about. And it's, again, one of the reasons why I like this company, because they don't have a lot of debt. Also, we're going to talk about this on the balance sheet, but this company owns over 2.5 million square feet worth of real estate in manufacturing facilities, and they own it. And since they own that facility and they have no debt, that means they own it free and clear. And that real estate might be worth $250 or $300 million, perhaps double that. So anyways, the operations of this company, very, very average. Nothing exceptional, nothing exciting. If you knew nothing else about this company and you knew nothing about this industry, the operations would dissuade you from buying the stock. So please check back over the next few days and watch the video on dividends, watch the video on the balance sheet and the video on wealth creation, and you'll see why I'm more excited about this company than I am simply looking at the operations. So that's it for today. I'm James Robinson. This is my stock pick of the week. Thank you very much. In summary, you would never buy Ruger because you think it's the best operated company in the world or because you think it has a strong moat. It's neither. It's very average, and it's probably slightly a commodity business. We're buying it because we can do it at 13 times earnings. I think those earnings are going to increase, and thus I think the stock's going to do well. And I simply believe we're buying the stock at below its intrinsic value. I look for companies with a gross margin of at least 40%. This company's gross margins are 25%, so they're nowhere near exceptional. My minimum, however, is 20% gross margins, and this company is enough above that I didn't rule it out of hand due to gross margins. The earnings for this company have been pretty volatile, but the good news is that then when things go well, they spike significantly, and I expect that that's what's going to happen in 2021, which is why I'm buying the stock. Also, if it takes a couple of years to perform, I'm okay because we're getting a nice dividend. The company's hovered in the top 25% of companies in the last 10 years in terms of income as a percent of revenue. So that's pretty good. We'll accept that. That's not a reason to hate the company. Selling and general administrative is pretty average, which what you would expect for a commodity business. It's been running the wrong way, which I don't like. But the company has improved. As an offset against that, the company has really improved the amount of money that has tied up in inventory, which is a good sign because reducing inventory means that we have more ability to make money, and there's still demand for our products, even though our sales have been down a little bit. The plants and equipment for the company is a highlight. It's going in the right direction, and in fact, it's actually going further the right direction than we think, because I happen to know it owns all of this real estate, which I think the value of the real estate's increasing. R&D for the company is zero. Interest rates are basically zero. Interest expense is basically zero. So you add it all up, there's nothing in the operations of the company that it's terrifying or that would scare you away from it. There's just nothing in there that would excite you. So that's it for Ruger. Again, the highlights of this company are not, they're not the operations. Tune in to watch on dividends and balance sheet and wealth creation, and you have a better sense of why I'm high on this company. Thanks for your time.